Hello and welcome to Talking Point. My guest today is Ganeshram Jayaraman, MD and Head of Avendus Spark Institutional Equities. Ganesh, thank you very much for joining us on BQ Prime. I was
Pleasure,
going through
sir.
your latest report, June report, and uh, you seem to be in the middle of whether you basically the argument that you're making is neither a blue sky nor it's a cloudy sky. Uh, what makes you being very circumspect and cautious?
So our portfolio strategy recommended is built on margin of safety. Okay, because we are saying that it's not a kind of environment conducive for aggressive growth expectations. We think there are certain things which are improving in the macro for sure. Okay, but whether they are sustainable improvements we want to see early stage of falling inflation, commodity prices can be good for current account deficit and the macro, but is it indicating a slowdown coming? Okay, which is what we are trying to assess. So certain things definitely improvement, but uh, there are also certain things which are deteriorating. So we don't want to see other side of the coin and miss out. So we want to keep that in mind. Thirdly, there are certain things which are unclear, okay, which can go either side. So we can talk on all three. Firstly, what is improving? For sure, the whole forex reserves, the current account deficit, the whole the macro picture on how we saw the pressure on interest rates and liquidity, that seems to have eased off a fair bit, but it's come through certain line items which are, whether it's sustainable, we want to see business services, it's become a $20 billion line item. Whether it's sustainable improvement we want to watch. Second is the 2000 rupee note recall has led to a surge in deposit growth in the last 4 weeks. How long it will remain? Will it go back as currency again? Will that again bring liquidity down and put pressure on the system? We want to watch. Second improvement which has happened, though, is which is what a big call has been all these years, the last couple of years, has been the whole Capex cycle. Okay, when I see data on the FY23 and especially the fourth quarter data, and how it likely plays out in FY24 and 25, our confidence on this cycle remains possibly at the highest that we have had. Okay, and that continues. When I see Capex project announcements, when I see actual Capex which balance sheets are reflecting, when I see order book momentum of construction or capital goods companies, uh, our confidence on how this whole cycle on Capex can play out gets better. When I study corporate balance sheets, the extent of operating cash flows available for Capex, post tax, post interest, when I study it across sectors, you realize that there is a lot more scope for much higher levels of capex in the economy. You study capacity utilizations, you study the balance sheets, you study the cash flows, you study another important part in all of this is continued industry market share consolidation happening across maybe about 20 sectors. Sectors like banks, 80% of the growth is coming from 6 banks. Okay, sectors like cement, six constitute almost 90 plus percent of the growth, 6 cement companies. Same in steel. Look at aviation, look at telecom, look at ports, passenger cars, even small sectors like pipes and small sectors. You're seeing very good kind of consolidation happening in the context of raw material prices easing and likely market share, kind of capex cycle building up. This is a very powerful build up. So the positives are definitely there, and we are reflecting that in our construct of how the model portfolio should be. The big becoming bigger is a continuing part of the whole thesis. But I don't want to, ignore what's deteriorating. Exports have fallen 4 or 5 months in a row, and the repercussions, the second order effect of a double digit decline in exports in the rest of the economy cannot be ignored. When you see IT sector, right? 2 quarters of declining employee hiring base, that tends to tell you that there will be an impact on urban discretionary consumption with the lag. Cities like Chennai, Bangalore, or Hyderabad, or NCR, Pune, very high dependence on IT as a rub off into the economy. Okay, in these cities especially. Okay, the third is whenever we have seen WPI go into negative trajectory, we have seen the ensuing 3-4 quarters growth rates moderate because commodity prices cool off in anticipation of weaker demand, and then the first is a benefit, but then comes the slowdown, which is volume slow. So I'm positive on gross margins, and but I'm cautious on volume growth. Okay, so absolute EBITDA growth, absolute top line growth could be, but gross margins and gross profit growth can be healthy. So this is what we are seeing. We're also watching, how every time interest rates have peaked out in India, 2001, 2007, 2000, maybe 11, 14, 18. There have been 5 occasions in 20 years. How did the economy, how did the markets react in the 12 months after interest rates peaked out? How it behaved in the 12 months or 3-6 months lead up to the peak out? When you look at it, clearly you see a pattern that in the lead up or immediately after, markets do well, but the 3, 6, 12 months after interest rates peaked out, slowdown gets seen most often than not. Markets returns are mixed, so it's not as clear a blue sky picture as it's appearing and as the markets seem to be kind of reflecting. So we are keeping all these in mind, and as a result, we are recommending clients to have an element, or the underlying bedrock of our recommended strategy is margin of safety. Margin of safety means kind of room for error. Okay, build companies where but we can talk if you have any
Yeah,
questions
yeah. So
on the
that's
macro
why I
side. We
wanted to
can talk
come
and
in. You touched about multiple factors, and maybe we can take one by one and get your views on that. To start off with the 2,000 rupees one, while you say that the deposits into the banks are going to go up, and there may be a liquidity issue which is there, but it's only the cash circulation which is going to come down, but and that to by 3.2 lakh odd crores, because that's 2,000 rupee notes are not much enough. So do you see that kind of thing also driving consolidation with respect to digitization and others? Is that a big trigger? Last time we saw that happening as a big trigger, but this is as percentage of the total cash in the economy, it's a very little amount. And when you say that banks, only 6 banks are contributing to 80% of the growth, how do you see the other banks in the sector?
So, firstly, the 2000 rupee note. Keep in mind that the 2000 rupee note was not a circulated currency. It was predominantly lying in wardrobes and lockers and hoarded in some form. Okay, so it wasn't helping consumption in a fair bit. So now it's come into deposits. Now when it goes back as 500 rupee note, will it behave differently? That's the key question. Will it actually help consumption? Okay, because the character of 2000 and 500 are different, or because it's now come into deposits from being it was what was lying idle, will it stay back as deposits lot higher proportion, lot longer? Okay, that can be a favorable. So two things, and as you said, 3.3 lakh crores, 85% of that is seeing this return recall. It's pretty large, actually. It's not small, it's pretty large. At the margin, 2.5 lakh plus crores is a pretty large impact if it has behavioral pattern changes vis-a-vis lying idle. That's what I'm reiterating.
Okay.
The second point is the banks. Okay, we our comfort remains with the large banks. Of course, there are selective out banks out of the top six, but our comfort remains with the how these large banks can demonstrate even further strengthening of their already strong position. So, be it their capital position, when you see their uh, distribution increase that many of them are planning, when you see their strength in provisioning, okay, uh, balance sheets are overcapitalized, P&Ls are over provisioned. So there is a lot more scope for return on assets improvement and return on equity expansion. So, of course, there will be a margin constraint showing out beyond June quarter for the next 4 quarters, but we think that can be moderated or absorbed by other categories of the income statement. So, return on assets can be still in very strong territory, possibly much better than what it was earlier. So we will kind of remain constructive on the large banks for sure.
Mhm. Uh, on the issue of the interest rate cycle peaking and how you said that in the post peaking 3 6 to 9 or 12 months you see a decline that comes in. uh, when do you see the peak happening? Has it already happened? Because if you look at the inflation trajectory, the governor or the Reserve Bank is now saying that we might see interest going back to 5.5% by the end of the year and then again declining. So you're still not out of the woods as far as inflation trajectory is concerned. So when do you see this interest rates peaking?
So, fair question. We are working with the principal or primary assumption that interest rates are very close to the peak or have peaked. Okay, inflation due to MSP increase, they can go up a little bit, but if demand weakens, that can also get addressed a bit. But also keep in mind the whole industry consolidation point I said, and due to which, even if WPI is kind of moderating, I think CPI will remain on the higher side. Okay, so pricing power will also be an important point kept in mind. But to cut the long story short, uh, closer to the peak than the peak is our key call. Not the peak, but closer to the peak. Uh, so so. But what matters is growth. It's not interest rate cycle which we are more concerned about now. It's growth. What happens to growth after all the spike in interest rates that we have seen over the last 12 18 months? What happens to growth? The initial period, the consumers, corporates, they've absorbed it because there was so much liquidity prior to this, after COVID started and all these, maybe even years before, you had absorbed liquidity. That was a buffer with the consumer's hands, right? But from here on, we are at crossroads. Okay, and we will, if interest rates don't come down, and our view is the interest rate differentials between India and US are so narrow that India will not see rate cycle coming down in the next 12 18 months also, unless demand capitulates, which is not our base case. That we think demand can moderate for it to see a sharp fall in demand. uh, at that stage rate cycle can come down, but otherwise we will continue to see a rate cycle pretty much where it is today in India.
So your assumption, and correct me if I'm wrong. Your assumption is that we might see volume moderating on the top line part of it. Pricing may not be that kind of robust because global headwinds or commodity prices are easing. Uh, Now I wanted to extrapolate that into the key figure that we do, right? Means GST growth, which is coming month on month, and we've been seeing more than double-digit growth coming in GST. And GST gives you a trend of what the top line growth is coming for India Inc. We haven't seen that moderation happening in the GST numbers. Though in the advanced tax numbers, we've seen some moderation happening. That's primarily because your margins have been hit for some of the key sectors which are commodity led. But on the top line part, we have not seen that kind of moderation. How do you put these two blocks and come to a good reasoning here?
WPI is negative. Okay, so GST is volume multiplied by value. If WPI is negative, it will have an impact on GST growth. It will happen over the ensuing 9 months. It always there is a time lag. Okay, so you will see GST collections moderating to single digits, maybe even by the time the year ends, even mid single digits. So that growth, that it will be led by negative WPI. But keep in mind, I still say that pricing power due to market share consolidation will lead to not this full benefit not being fully passed on to the end consumer. So it will reflect in gross margins,
Mhm. Uh,
better gross margins.
Another factor which is important to note, and you've been mentioning in your report, is the capex cycle. We've seen in FY23 roughly orders for 23 lakh crores being rolled out by various companies, and that leading to bulging of the order books for many of the companies. How do you see that capex cycle coinciding with your thesis that, even though interest rate cycles peak out, we're not going to see immediate fall of interest happening in the next 12 to 18 months?
So Capex cycle this time around is a little different in character. Okay, it is more led by the larger companies who have consolidated market share, want and who have improved their balance sheets during this last few years, wanting to keep that consolidated nature of market industry structure intact. So why else will you're seeing a surge in, for example, the two large airlines in India have ordered massive aircrafts. Why is it? It's not just demand. It's because you want to keep the industry character of duopoly or evolving duopoly, evolving consolidation. You want to keep it intact. That's the primary driver for capex. Okay, that's what's happening in property, for example. The large developers are actually trying to consolidate their position further by launches. Okay, you're seeing that character reflected in multiple sectors. Okay, even in cement, eventually it will happen, which is why cement companies are launching capex. Eventually it will happen in steel as well, maybe little delayed due to the environment of steel in China, but it will play out eventually. So you are going to see this character of consolidation leading to not just gross margin improvement but also capex. Balance sheets of these companies are in phenomenal shape. I don't see them leveraging to do capex. The internal accruals, the cash position over the next, what is now today already there, and what will be the operating cash flows next 2 3 years will fund most of the capex they are planning. So interest rates going up a bit or staying a little elevated, I don't think will deter the kind of capex that we are seeing. It was very different earlier cycles. It was leveraged capex in a big way. This time, it's not as much leveraged capex, and that's an important difference. Also, the PLI related capex, the data center related capex, these are also not heavily leveraged capex, more by MNCs or by larger Indian companies who are not to leverage. So this cycle on capex, at least for the ensuing 12 24 months, doesn't appear to be heavily leveraged. That's the key difference.
Mhm. In If that is the case, how do you see growth coming in earnings for maybe the Nifty 50 companies? If you've seen that, what kind of growth you're going to see for FY24 or 25? If you have you penciled in that kind of growth?
Yeah, I think we are looking at late teens earnings growth potential for the entire Nifty. But if you eliminate financials, I think it will fall down to maybe even just about double digits, or and that has some risks of downgrades. Okay,
Mm.
so I think earnings downgrades as we go into the year, possible probability of it happening is quite high.
So, financials for sure. Any other sector which is going to be the growth driver? Because last year we saw what? We saw some growth coming from FMCG, autos, and banking and financials. Are these the three sectors which will continue to drive earnings in this fiscal as well?
Cement industrials, we think earnings upgrades and earnings growth can come. Staples, to some extent, consumer staples.
And the laggards would be?
IT will be a laggard.
Hmm.
Okay, metals could be a laggard.
Hmm.
Autos could be neither here nor there. Okay,
Hmm.
uh, which leaves you with what? I think financials we discussed. So broadly, these.
You spoke about interesting concept, right? The falling employee count of IT companies in the last 2 quarters, and that how that may have an impact on the uh, discretionary spend in top 7 8 cities. Because the IT companies are also present in these 7 8 cities. What kind of impact will that have on the real estate market? Because you spoke about the fact that a lot of builders are putting out new launches. Now that puts a big question mark on demand for those launches if there is a discretionary issue which is coming in these urban cities.
It takes time. Okay, markets will react earlier, but the actual consumption impact takes a lot longer. If you studied earlier cycles, the same thing. India's had IT driving property, at least in these 7 8 cities now, for more than 20 years. So we have enough data to study how and when the impact came, and how it impact reflected in actual performance. So when real interest rates are where they are today, the impact is still not going to be there. The affordability is still there. IT companies did give wage hikes and hired significantly in calendar 21 and 22, and calendar 23 or FY 23 also saw some bit of moderation. So it's not that the buffers are not there. So it takes time for this kind of interest rate environment or IT slowing down to have play its repercussions. Also, keep in mind that the rupee had depreciated, so NRI remittance had kind of come in the previous 12 months, and that can actually help. Where does that money go? It can, and the reasonably high probabilities that we have seen, that it tends to also go into property. So property is a kind of a mixed bag. On one hand, the actual demand can be pretty good, but how markets will see it in the context of interest rate cycle, and markets will be always early in picking these. So it's going to be a dichotomous situation, which is what has been last 12 months also. Markets were worried on property, but the actual sales launches have actually been pretty good. That dichotomous trend, I think, will continue.
The fund flows which are coming from outside, especially by NRIs remitting into the country, we've seen a large part of that going into commercial real estate because the yields are much higher there as compared to residential, and the launches which we are seeing is primarily on the residential side. Do you see or foresee, not immediate future, but maybe a tendency of having high inventories building up over a period of next 2 to 3 years if this IT trend continues for maybe another few quarters?
Possible, I won't rule it out, but also keep in mind there were some tax changes on the 10 crore capital gains limit being put on. So that also kind of drove some demand of late. You're also seeing you know a character where the luxury premium houses are selling much more than the affordable, or the you can call the economy segments of premium of housing. So there has been that pattern also. Okay, and that is also, is it sustainable is a question. But as I said, property is a very important driver of unorganized, or you can call blue collar labor. Almost a fourth of India's blue collar labor is employed in construction. So it is and it leads to remittance money back home. And so construction, property, infra spend, all these are pretty important drivers. And I think in the next 12 months, it will continue. How it plays out in FY 25 is where the property and infra government spend. That's where the actual slowdown, if the macro were to remain weak. If the macro changes, that can again continue too. So we'll watch the lead indicators for that. Then I think the performance on the ground will remain healthy next 12
No,
months.
we had a data point which came out yesterday from one of the consultants, Anurag. It said that in the MMR region, which is the Mumbai region, properties about 2.5 crores have, inventory has fallen for those kind of properties about 2.5 crores, while there is a buildup of inventory which is happening for sub 2.5 crores. Uh, how do you make sense of this trend which is coming in?
This dichotomy is happening across cities, not just in property. It's happening in across categories. If you see passenger cars priced above 7 lakhs are selling much more than cars priced below 7. It's happening in segments like even liquor or footwear or apparels. Okay, so it's happening across categories. This kind of premium, is it premiumization? Is it affordability going up, or is it the kind of you can call the K-shaped impact? Okay, or is it a changing consumer behavioral pattern which is driving this? Okay, as I said, there are lots of changes in the whole consumption side of the economy. Some are affordability led, some are inflation led, some changes are behavioral led. We are also seeing a pattern of the categories like, say, what were small pre-COVID, like smartphones or gaming or OTT, or you could call I could name wearables and so many hearables like this. So spend by the consumer is much more, many times more cumulatively than what it was uh, 3 years back. Okay, so is that cannibalizing our core consumption categories? So we look at two-wheeler sales still down 25% to what it was 3 years back, but uh, you know consumer is spending somewhere else. So what does it mean for earnings assumptions that we have? What does it mean for valuations? The multiples that we assign, is a function of terminal growth rate. So how secular is that terminal growth? Because that's what drives whether it's a 40p or a 10p. It's the longer term secular growth, the terminal growth. So clearly, consumption is at a crossroads. Lots of things that we need to ponder to take that decisive strength. It's a decisive call. Industrials, manufacturing, capex, lot clearer, lot more comfortable for us in pitching, even if they appear expensive. But the same expensive consumer stocks, we are questioning our calls in some form.
And that's why you say the K-shaped recoveries may not be sustainable.
Yeah, I mean, how will you react? How will politicians and policymakers react to this? In an election year, okay, uh, will they? So far, not much, but we can't be, assuming this is the way it will be. Okay, we don't want to assume that this trend will, sustain for long.
Mhm. Ganesh, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thanks. Good speaking to you.
Thank you.